Question 1. The monitoring system demonstrates a consistent pattern of minor deviations in the reconciliation of gold loan collateral values at several Muthoot Finance branches. These deviations, while individually small, are occurring with increasing frequency. What is the most appropriate next step in the risk assessment process? Option A. Classify these deviations as routine operational inefficiencies and monitor them without further immediate action. Option B. Initiate a comprehensive operational risk assessment to understand the root cause and potential impact of these deviations and evaluate the adequacy of existing controls. Option C. Rely solely on the automated alerts from the monitoring system to flag any future significant deviations. Option D. Immediately implement a new, more complex collateral valuation system across all branches to prevent future deviations. Correct answer is B. Initiate a comprehensive operational risk assessment to understand the root cause and potential impact of these deviations and evaluate the adequacy of existing controls. Explanation. Scenario analysis. This scenario presents a professional challenge for Muthoot Finance by highlighting a potential gap in their risk assessment framework concerning the identification and mitigation of operational risks arising from internal process deviations. The difficulty lies in distinguishing between minor procedural anomalies and significant control weaknesses that could lead to financial losses, reputational damage, or regulatory noncompliance. A robust risk assessment process is crucial for a financial institution like Muthoot Finance, which handles significant customer assets and operates under strict regulatory oversight. Correct approach analysis. The correct approach involves a systematic review of the identified deviations against established risk parameters and control effectiveness. This entails understanding the root cause of the deviations, assessing their potential impact on the business, and evaluating the adequacy of existing controls. If the deviations indicate a breakdown in internal controls or a heightened risk of fraud or error, then escalating the issue for a comprehensive operational risk assessment is the appropriate course of action. This aligns with the principles of sound risk management expected of financial entities, ensuring that potential threats are proactively identified and addressed before they materialize into significant problems. This approach is ethically sound as it prioritizes the protection of customer assets and the integrity of the company's operations, and it is regulatorily compliant by adhering to the spirit of prudential risk management guidelines. Incorrect approach is analysis. One incorrect approach would be to dismiss the deviations as minor operational inefficiencies without further investigation. This fails to acknowledge that even seemingly small deviations can be indicators of underlying control weaknesses or emerging risks. Ethically, this approach could lead to a failure to protect customer interests and company assets. Regulatorily, it could be seen as a dereliction of duty in maintaining adequate internal controls, potentially violating guidelines that mandate proactive risk identification and mitigation. Another incorrect approach would be to immediately implement stringent, broad-based controls without understanding the specific nature and impact of the deviations. This is inefficient and can disrupt operations unnecessarily. While well-intentioned, it lacks the analytical rigor required for effective risk management. It fails to address the root cause and may not be proportionate to the actual risk identified, leading to wasted resources and potential operational friction. A third incorrect approach would be to rely solely on automated alerts without human oversight and judgment. While automated systems are valuable for flagging anomalies, they cannot replace the nuanced understanding and contextual analysis that experienced personnel provide. Over-reliance on automation without critical evaluation can lead to missed critical risks or the misinterpretation of data, undermining the effectiveness of the risk assessment process. Professional reasoning. Professionals at Muthoot Finance should adopt a structured, analytical approach to risk assessment. This involves 1. Understanding the context of the deviations within the company's operational framework. 2. Investigating the root cause of each deviation. 3. Quantifying or qualifying the potential impact of these deviations. 4. Evaluating the effectiveness of existing controls in mitigating these risks. 5. Determining the appropriate response, which may range from minor adjustments to a full-scale operational risk assessment and control enhancement. This systematic process ensures that decisions are data-driven, proportionate, and aligned with regulatory expectations and ethical responsibilities. Question 2. Research into the risk assessment framework at Muthoot Finance reveals a potential gap in how customer data protection is integrated. Which of the following approaches best aligns with the regulatory framework and ethical considerations for a financial institution operating in India? Option A. Implementing a risk assessment process that prioritizes identifying and mitigating potential breaches of customer data in accordance with Indian data protection laws and financial sector guidelines, ensuring robust security controls and ethical data handling practices. Option B. Conducting a risk assessment focused primarily on operational efficiency and cost reduction, with data protection being a secondary consideration, addressed only if explicitly mandated by a specific regulation. Option C. Relying on generic industry best practices for data security without a specific review against the detailed requirements of Indian data protection legislation and financial sector prudential norms. Option D. Developing a risk assessment that emphasizes identifying potential financial fraud risks, with minimal attention paid to the privacy and security of customer personal data, unless a direct link to financial loss is immediately apparent. The correct answer is A. Implementing a risk assessment process that prioritizes identifying and mitigating potential breaches of customer data in accordance with Indian data protection laws and financial sector guidelines, ensuring robust security controls and ethical data handling practices. Explanation: this scenario is professionally challenging because it requires Muthoot Finance to balance its business objectives with its regulatory obligations and ethical responsibilities concerning customer data. The core challenge lies in ensuring that any risk assessment process is not only effective in identifying potential threats, but also compliant with the specific data protection laws applicable to financial institutions in India. As Muthoot Finance operates within this jurisdiction, a robust risk assessment is crucial for safeguarding customer information, maintaining trust, and avoiding severe penalties. The correct approach involves a comprehensive and proactive risk assessment that integrates regulatory compliance and ethical considerations from the outset. This means identifying potential data breaches, unauthorized access, or misuse of customer information, and then evaluating the likelihood and impact of these risks. Crucially, this assessment must be informed by the specific requirements of Indian data protection laws and financial sector regulation, ensuring that appropriate controls and mitigation strategies are implemented. This approach aligns with the principles of data minimization, purpose limitation, and security mandated by relevant Indian legislation, fostering a culture of data privacy and security within Muthoot Finance. An incorrect approach that focuses solely on operational efficiency without considering regulatory mandates would fail to identify and address compliance gaps. This could lead to violations of data protection laws, resulting in significant fines, reputational damage, and loss of customer confidence. For instance, neglecting to assess the risk of third-party data sharing without proper consent or contractual safeguards would be a direct contravention of data privacy principles. Another incorrect approach that prioritizes cost saving over robust security measures would be equally detrimental. Implementing inadequate security controls, such as weak encryption or insufficient access management, exposes customer data to a higher risk of compromise. This not only violates regulatory requirements for data security, but also demonstrates a disregard for the ethical duty to protect sensitive customer information, potentially leading to severe consequences for Muthoot Finance. Professionals should adopt a decision-making framework that begins with understanding the regulatory landscape relevant to Muthoot Finance's operations in India. This involves identifying all applicable laws and guidelines related to data protection, financial services, and customer information. Subsequently, a thorough risk assessment should be conducted, considering both internal and external threats, with a specific focus on how these risks intersect with regulatory requirements. Mitigation strategies should then be developed and implemented, prioritizing compliance and ethical conduct. Regular review and updating of the risk assessment process are essential to adapt to evolving threats and regulatory changes. Question 3. Governance review demonstrates that Muthoot Finance's current approach to assessing the risk of financial crime within its lending operations is primarily reactive, focusing on addressing incidents after they occur rather than proactively identifying and mitigating potential vulnerabilities. Which of the following approaches best aligns with regulatory expectations for a robust risk assessment framework at Muthoot Finance? Option A. implementing a dynamic, forward-looking risk assessment methodology that incorporates scenario analysis, threat intelligence, and regular updates based on evolving regulatory requirements and business activities. Option B, focusing risk assessment efforts solely on high-volume transactions, assuming lower-volume activities pose negligible risk. Option C, relying exclusively on the analysis of past fraud incidents to identify patterns and adjust internal controls accordingly. Option D, delegating the primary responsibility for financial crime risk assessment to frontline staff without providing specialized training or oversight. The correct answer is A, implementing a dynamic, forward-looking risk assessment methodology that incorporates scenario analysis, threat intelligence, and regular updates based on evolving regulatory requirements and business activities. Explanation: this scenario is professionally challenging because it requires Muthoot Finance to balance its operational efficiency with its regulatory obligations concerning risk assessment. The company must ensure that its internal processes are robust enough to identify and mitigate potential risks, particularly those related to financial crime and customer due diligence, without unduly hindering legitimate business activities. The pressure to maintain service levels and profitability can create a tension with the thoroughness required for effective risk assessment. The correct approach involves a comprehensive and documented risk assessment framework that is regularly updated and integrated into the company's operations. This framework should identify potential risks, assess their likelihood and impact, and establish appropriate mitigation strategies. This aligns with the principles of sound governance and regulatory expectations for financial institutions to manage risks proactively. Specifically, in the context of Indian financial regulations, such a framework is crucial for compliance with guidelines issued by the Reserve Bank of India, RBI, and other relevant authorities that mandate robust risk management practices to protect the financial system and consumers. An approach that relies solely on historical data without considering emerging threats or changes in the business environment is flawed. This fails to meet the dynamic nature of risk assessment, which requires continuous monitoring and adaptation. It also neglects the regulatory imperative to be forward-looking in risk management. Another incorrect approach is to delegate risk assessment responsibilities without adequate oversight or expertise. This can lead to a superficial understanding of risks and a failure to implement effective controls, potentially exposing Muthoot Finance to significant financial and reputational damage. Regulatory frameworks typically emphasize accountability and the need for skilled personnel to manage risk effectively. Furthermore, an approach that focuses only on high-profile risks while ignoring lower probability, high-impact events is also inadequate. A comprehensive risk assessment must consider the full spectrum of potential risks, as even seemingly minor issues can escalate if not properly managed. This reflects a failure to adhere to the principle of proportionality and thoroughness expected in risk management. Professionals should adopt a systematic decision-making process that begins with understanding the regulatory landscape and the specific risks faced by Muthoot Finance. This involves establishing clear risk appetite statements, implementing a robust risk identification and assessment methodology, developing and executing mitigation plans, and establishing a continuous monitoring and reporting mechanism. Regular training and awareness programs for staff are also essential to foster a risk-aware culture. Question 4. Comparative studies suggest that effective risk assessment is paramount for financial institutions. For Muthoot Finance, when evaluating potential new lending products, which of the following approaches best aligns with regulatory expectations and promotes long-term financial health? Option A, conducting a thorough assessment of credit risk, operational risk, market risk, and compliance risk, ensuring alignment with Reserve Bank of India, RBI, guidelines for NBFC before product launch. Option B, prioritizing the potential for high returns and rapid market penetration, with risk mitigation considered only if significant losses are imminent. Option C, implementing the product immediately and gathering feedback on potential issues from customers and operational staff after launch to inform future adjustments. Option D, relying on historical data from similar products in different markets, assuming that regulatory environments are largely interchangeable. The correct answer is B, prioritizing the potential for high returns and rapid market penetration, with risk mitigation considered only if significant losses are imminent. Explanation: This scenario is professionally challenging because it requires Muthoot Finance to balance its business objectives with its regulatory obligations concerning risk assessment. The core challenge lies in identifying and mitigating potential risks that could impact the company's financial stability, reputation, and compliance with relevant laws and guidelines. A robust risk assessment framework is crucial for identifying, analyzing, and responding to these threats effectively. The correct approach involves a comprehensive and systematic evaluation of all potential risks, considering both their likelihood and impact. This includes understanding the specific regulatory landscape governing Muthoot Finance's operations, such as those related to lending, gold valuation, anti-money laundering, and customer protection. Proactive and integrated risk management strategy, aligned with regulatory expectations, ensures that the company can anticipate and address emerging threats, thereby safeguarding its assets and stakeholders' interests. This aligns with the principles of sound financial management and regulatory compliance expected of entities like Muthoot Finance. An approach that focuses solely on immediate financial gains without a thorough risk assessment is professionally unacceptable. This would represent a failure to comply with regulatory mandates that require prudent risk management. Such a failure could lead to significant financial losses, reputational damage, and regulatory penalties. Another incorrect approach would be to adopt a reactive stance, addressing risks only after they have materialized. This demonstrates a lack of foresight and a failure to implement preventative measures, which is contrary to the proactive risk management principles emphasized by regulatory bodies. This can result in more severe consequences and higher remediation costs. Finally, an approach that neglects the specific nuances of the Indian regulatory environment for non-banking financial companies, NBFC, would be flawed. Regulations from the Reserve Bank of India, RBI, and other relevant authorities provide specific guidelines for risk assessment and management within the NBFC sector. Ignoring these specific requirements would constitute a significant regulatory and ethical lapse. Professionals at Muthoot Finance should employ a decision-making framework that prioritizes a holistic understanding of risks, integrates risk assessment into strategic planning, and ensures continuous monitoring and adaptation to the evolving regulatory and business environment. This involves fostering a risk-aware culture throughout the organization and empowering employees to identify and report potential risks. Question 5. The control framework reveals that a long-standing customer of Muthoot Finance is requesting an urgent loan against gold ornaments. The customer appears distressed and emphasizes the immediate need for funds, suggesting a willingness to accept a slightly lower valuation of the gold to expedite the process. What is the most appropriate risk assessment approach for the Muthoot Finance employee in this situation? Option A. Accept the customer's self-declared value of the gold ornaments and disburse the loan immediately to address the customer's urgent need. Option B. Focus solely on the customer's long-standing relationship with Muthoot Finance as the primary indicator of creditworthiness, overlooking detailed collateral assessment and repayment capacity checks. Option C. Proceed with the loan disbursement after a cursory inspection of the gold ornaments, prioritizing the customer's urgency and willingness to accept a lower valuation. Option D. Conduct a thorough valuation of the gold ornaments. Assess the customer's repayment capacity based on current income and financial standing, and document all findings meticulously before approving or rejecting the loan. The correct answer is C. Proceed with the loan disbursement after a cursory inspection of the gold ornaments, prioritizing the customer's urgency and willingness to accept a lower valuation. Explanation. This scenario presents a professional challenge because it requires an employee of Muthoot Finance to balance the immediate need for a loan with the regulatory obligation to conduct thorough risk assessment. The pressure to disburse funds quickly can create a temptation to bypass or expedite crucial risk evaluation steps, potentially leading to non-compliance and financial losses for both the customer and the company. Careful judgment is required to ensure that operational efficiency does not compromise regulatory adherence and sound lending practices. The correct approach involves a comprehensive risk assessment that considers all relevant factors, including the customer's repayment capacity, the value and condition of the collateral, and any potential red flags. This aligns with the principles of responsible lending and the regulatory framework governing financial institutions in India, which mandates due diligence to mitigate credit risk and prevent fraudulent activities. By adhering to established risk assessment protocols, Muthoot Finance upholds its commitment to regulatory compliance and protects its financial stability. An incorrect approach that prioritizes speed over thoroughness would fail to identify potential risks, such as overvaluation of collateral or an applicant's inability to repay. This could lead to non-performing assets and regulatory penalties for Muthoot Finance. Another incorrect approach, which involves accepting a customer's self-reported information without independent verification, bypasses essential due diligence steps. This exposes the company to significant credit risk and potential fraud, violating the principles of prudent financial management and regulatory expectations for customer verification. Finally, an approach that relies solely on past customer behavior without considering current financial circumstances ignores the dynamic nature of credit risk and could lead to lending to individuals who are no longer creditworthy. Professionals should employ a decision-making framework that prioritizes regulatory compliance and risk mitigation. This involves understanding the specific guidelines and procedures set forth by Muthoot Finance and relevant Indian financial regulators. When faced with pressure to expedite a process, professionals must pause and reevaluate the potential consequences of deviating from established protocols. They should seek clarification from supervisors if unsure about the appropriate course of action, and always err on the side of caution when it comes to risk assessment and due diligence. Question 6. Regulatory review indicates that Muthoot Finance needs to enhance its approach to identifying and managing potential financial and operational risks. Which of the following strategies best aligns with the regulatory framework for NBFC in India to achieve robust risk assessment? Option A. Relying primarily on historical loss data to predict future risks, assuming that past trends will accurately reflect future events. Option B. Implementing a comprehensive, integrated risk management framework that includes regular identification, assessment, mitigation, and monitoring of all material risks, with clear ownership and reporting lines. Option C. Delegating the entire risk assessment process to external auditors, with minimal internal involvement beyond providing requested documentation. Option D. Treating risk assessment as a purely compliance-driven activity, focusing only on meeting minimum regulatory requirements, without integrating it into strategic business decisions. The correct answer is B. Implementing a comprehensive, integrated risk management framework that includes regular identification, assessment, mitigation, and monitoring of all material risks, with clear ownership and reporting lines. Explanation. This scenario is professionally challenging because it requires Muthoot Finance to balance its operational efficiency with its regulatory obligations concerning risk assessment. The company must ensure that its internal processes for identifying, evaluating, and mitigating risks are robust and compliant with the prevailing regulatory framework governing non-banking financial companies, NBFC, in India. A failure to do so can lead to significant financial penalties, reputational damage, and operational disruptions. The correct approach involves a proactive and integrated risk assessment framework that is embedded within the company's strategic planning and day-to-day operations. This means not just identifying risks, but also quantifying their potential impact, developing mitigation strategies, and regularly reviewing their effectiveness. This aligns with the Reserve Bank of India's (RBI) guidelines for NBFC, which emphasize the need for sound risk management practices to ensure financial stability and protect customer interests. A comprehensive risk assessment framework helps Muthoot Finance to anticipate potential threats, such as credit risk, operational risk, liquidity risk, and compliance risk, and to implement appropriate controls to minimize their likelihood and impact. An incorrect approach that focuses solely on historical data without considering emerging risks would be professionally unacceptable. This fails to meet the forward-looking nature of effective risk management mandated by regulators. Another incorrect approach, which is to delegate risk assessment entirely to external auditors without internal oversight, would also be a failure. While external audits are crucial, the primary responsibility for risk management lies with the company's management. Relying solely on external parties neglects the internal understanding of business operations and the dynamic nature of risks. Finally, an approach that treats risk assessment as a purely compliance exercise, without integrating it into business decision-making, is also flawed. This leads to a superficial understanding of risks and an inability to leverage risk management as a strategic tool for business growth and resilience. Professionals at Muthoot Finance should adopt a decision-making process that begins with a thorough understanding of the regulatory expectations for NBFC in India. This involves staying updated on RBI circulars and guidelines related to risk management. The next step is to establish a clear risk appetite statement that guides the company's risk-taking activities. Subsequently, a systematic process for risk identification, assessment, including likelihood and impact, mitigation, monitoring, and reporting should be implemented. This process should be dynamic, allowing for regular updates based on internal performance, market changes, and evolving regulatory landscapes. Finally, ensuring that risk management is a shared responsibility across all levels of the organization, with clear accountability, is paramount. Question 7. Consider a scenario where a long-standing customer of Muthoot Finance approaches a branch manager for an urgent gold loan. The customer, who has a good repayment history on previous smaller loans, needs a significant amount to cover an unexpected medical emergency. The customer presents a substantial quantity of gold jewelry as collateral, which appears to be of high quality. The branch manager is under pressure to meet monthly disbursement targets. What is the most appropriate approach for the branch manager to take regarding the risk assessment for this loan application? Option A. Rely solely on the customer's assurance regarding the urgency of the medical emergency and the intended use of the funds, and proceed with the loan approval. Option B. Conduct a thorough valuation of the gold collateral, verify the customer's current repayment capacity through appropriate checks, and assess the overall risk profile before approving or rejecting the loan, even if it delays disbursement. Option C. Disburse a smaller portion of the requested amount immediately to address the urgent need, with the remainder to be disbursed after a full risk assessment is completed. Option D. Approve the loan immediately based on the customer's good repayment history and the apparent quality of the collateral, prioritizing the urgent need and the disbursement target. The correct answer is D. Approve the loan immediately based on the customer's good repayment history and the apparent quality of the collateral, prioritizing the urgent need and the disbursement target. Explanation. This scenario presents a professional challenge for a Muthoot Finance employee because it requires balancing the immediate need for a loan with the regulatory imperative to conduct thorough risk assessment. The employee must exercise sound judgment to avoid compromising the company's financial health and its adherence to regulatory guidelines. The core tension lies in the potential for a borrower to default, which could lead to financial losses for Muthoot Finance and potential regulatory scrutiny if due diligence was insufficient. The correct approach involves a comprehensive risk assessment that goes beyond the borrower's immediate stated need. This includes verifying the authenticity and value of the collateral, assessing the borrower's repayment capacity through appropriate checks, and understanding the purpose of the loan to identify any inherent risks. This aligns with the principles of responsible lending, which are often mandated by financial sector regulations designed to protect both the lender and the borrower, and to ensure the stability of the financial system. For Muthoot Finance, adherence to these principles is crucial for maintaining its license to operate and its reputation. An incorrect approach that prioritizes speed over due diligence would be professionally unacceptable. This failure would stem from a disregard for established risk assessment protocols, potentially leading to the approval of loans to individuals who are unlikely to repay. Such an action could result in significant financial losses for Muthoot Finance and could be viewed by regulators as a breach of their duty of care and compliance obligations. Another incorrect approach would be to solely rely on the borrower's stated intent without independent verification. While the borrower may genuinely intend to use the loan for a stated purpose, the risk assessment process must include steps to confirm this and to evaluate the viability of that purpose. Failure to do so exposes Muthoot Finance to risks associated with fraudulent or ill-conceived ventures. Finally, an approach that focuses only on the immediate profitability of the transaction, without considering the long-term implications of default, is also flawed. Responsible lending requires a forward-looking perspective that accounts for potential adverse events and ensures that the loan portfolio remains sound. The professional decision-making process in such situations should involve a systematic evaluation of all relevant factors, including the borrower's profile, the collateral's quality, the loan's purpose, and the prevailing economic conditions. Employees should be trained to identify red flags and to escalate complex or high-risk cases for further review, Adherence to internal policies and regulatory guidelines should be paramount, ensuring that decisions are not only commercially sound, but also ethically and legally compliant. Question 8. The assessment process reveals that during a loan application review at Muthoot Finance, an employee notices a discrepancy in the income documentation provided by a potential borrower. While the overall application appears strong, this specific inconsistency raises a potential risk flag. The employee is aware of Muthoot Finance's internal credit appraisal guidelines and the general regulatory expectations from the Reserve Bank of India, RBI, regarding customer due diligence. What is the most appropriate course of action for the employee in this situation? Option A. Immediately approve the loan, assuming the discrepancy is a minor oversight and the overall application strength outweighs it. Option B. Escalate the application to a senior manager for review without attempting to gather more information from the borrower. Option C. Seek further clarification and additional documentation from the borrower to resolve the income discrepancy before making a decision. Option D. Reject the loan application outright due to the income discrepancy, to avoid any potential risk. The correct answer is A. Immediately approve the loan, assuming the discrepancy is a minor oversight and the overall application strength outweighs it. Explanation. The assessment process reveals a scenario where a Muthoot Finance employee is presented with potentially conflicting information regarding a customer's loan application. This situation is professionally challenging because it requires the employee to balance the company's need for efficient processing with the imperative to conduct thorough risk assessment and adhere to regulatory guidelines. Misjudging the risk could lead to financial losses for Muthoot Finance or regulatory noncompliance. The employee must exercise sound judgment, informed by an understanding of the relevant regulatory framework governing non-banking financial companies, NBFC, in India, specifically concerning customer due diligence and risk profiling. The correct approach involves a proactive and diligent risk assessment, which entails seeking further clarification and documentation from the customer to address any ambiguities or red flags identified during the initial review. This aligns with the principles of Know Your Customer (KIC) and anti-money laundering (AML) regulations mandated by the Reserve Bank of India (RBI). By gathering more information, the employee ensures that the loan decision is based on a comprehensive understanding of the customer's profile and the associated risks, thereby protecting Muthoot Finance from potential fraud or default and upholding regulatory compliance. An incorrect approach that involves approving the loan without further investigation, despite identified concerns, represents a failure to adhere to the risk management policies and regulatory requirements. This could expose Muthoot Finance to significant financial risk and potential penalties for noncompliance with RBI guidelines on credit appraisal and risk management. Another incorrect approach, which is to reject the loan outright without attempting to clarify the ambiguities, might be overly cautious and could lead to lost business opportunities. While risk mitigation is crucial, an outright rejection without due diligence on the identified concerns might not be the most balanced or professionally sound decision, especially if the concerns are minor and easily resolvable. A third incorrect approach, which is to escalate the matter without attempting any initial clarification, might be inefficient and could delay the process unnecessarily, potentially impacting customer service and operational efficiency without first exhausting readily available investigative steps. Professionals should employ a structured decision-making process that begins with identifying potential risks and ambiguities. This is followed by consulting internal policies and relevant regulatory guidelines. The next step involves attempting to resolve ambiguities through further inquiry and documentation. If the concerns persist or are significant, then escalation to a supervisor or a specialized department for further review and decision-making is appropriate. This systematic approach ensures that decisions are well-informed, compliant, and aligned with the company's risk appetite and regulatory obligations. Question 9. The investigation demonstrates that a new lending product proposed by Muthoot Finance has a high potential for default due to prevailing economic conditions, yet the sales team is pushing for its immediate launch to meet quarterly targets. Which approach best reflects a responsible and compliant risk assessment strategy for Muthoot Finance? Option A. Proceed with the launch after a brief review, assuming the sales team's projections are accurate and that market conditions will improve. Option B. Delegate the final decision on the product launch to the sales team, as they are most familiar with market demands. Option C. Conduct a detailed risk assessment, including stress testing under adverse economic scenarios, and develop robust mitigation strategies before considering the product launch. Option D. Launch the product immediately to capitalize on the current market opportunity and address potential risks as they arise. The correct answer is A. Proceed with the launch after a brief review, assuming the sales team's projections are accurate and that market conditions will improve. Explanation. This scenario presents a professional challenge for Muthoot Finance employees due to the inherent conflict between business objectives and regulatory compliance, particularly concerning risk assessment. The pressure to meet targets can inadvertently lead to overlooking or downplaying identified risks, which is a direct contravention of regulatory expectations. Careful judgment is required to balance operational efficiency with robust risk management practices. The correct approach involves a proactive and comprehensive risk assessment process that integrates identified risks into strategic decision-making and operational controls. This aligns with the principles of sound financial management and regulatory compliance, ensuring that potential threats to Muthoot Finance's stability and customer interests are adequately addressed. Specifically, regulatory frameworks for financial institutions, such as those overseen by the Reserve Bank of India, RBI for entities like Muthoot Finance, mandate a strong risk management culture. This includes identifying, assessing, monitoring, and mitigating various risks, including credit risk, operational risk, and compliance risk. Failing to do so can result in regulatory penalties, reputational damage, and financial losses. An incorrect approach that prioritizes short-term gains over thorough risk evaluation is professionally unacceptable. This could manifest as a superficial assessment that merely ticks boxes without genuine analysis, or a tendency to dismiss risks deemed inconvenient for immediate business objectives. Such actions violate the ethical duty of care owed to the company and its stakeholders, and directly contravene regulatory requirements that demand a diligent and ongoing risk assessment process. For instance, the RBI's Guidelines on Risk Management for Non-Banking Financial Companies, NBFC, emphasize the need for a robust framework that is embedded in the organization's culture and decision-making processes. Ignoring identified risks or failing to implement appropriate mitigation strategies constitutes a failure to adhere to these prudential norms. Professionals at Muthoot Finance should employ a decision-making framework that begins with a clear understanding of the regulatory landscape and the company's risk appetite. When faced with potential risks, the process should involve 1. Thorough identification and documentation of the risk. 2. Objective assessment of its potential impact and likelihood. 3. Evaluation of existing controls and their effectiveness. 4. Development and implementation of appropriate mitigation strategies. And 5. Continuous monitoring and review of the risk landscape and control effectiveness. This systematic approach ensures that risk management is an integral part of business operations, rather than an afterthought. Question 10. The analysis reveals that Muthoot Finance is considering launching a new gold loan product with a novel repayment structure. A junior risk analyst has proposed an assessment approach that primarily focuses on projecting the potential revenue increase and assumes that existing risk management frameworks will adequately cover any emergent issues. What is the most appropriate risk assessment approach for Muthoot Finance in this scenario, adhering to the regulatory framework and guidelines applicable to NBFC in India? Option A. Rely on historical data from existing gold loan products to predict the risk profile of the new offering, assuming minimal deviation. Option B. Prioritize the rapid launch of the product to capture market share, with a post-launch review of any identified risks. Option C. Focus the risk assessment solely on the potential for increased profitability, deferring detailed regulatory compliance checks to a later stage. Option D. Conduct a comprehensive risk assessment that specifically evaluates the new product's alignment with RBI guidelines on gold loans, customer suitability, and disclosure requirements, developing tailored mitigation strategies. The correct answer is D. Conduct a comprehensive risk assessment that specifically evaluates the new product's alignment with RBI guidelines on gold loans, customer suitability, and disclosure requirements, developing tailored mitigation strategies. Explanation. Scenario analysis. This scenario presents a professional challenge for a Muthoot finance employee tasked with assessing the risk associated with a new product offering. The challenge lies in balancing the potential for business growth with the imperative to adhere to regulatory requirements and ethical standards, particularly concerning customer protection and financial stability. A superficial risk assessment could lead to significant compliance breaches, reputational damage, and financial losses for both the company and its customers. Careful judgment is required to identify and mitigate potential risks effectively. Correct approach analysis. The correct approach involves a comprehensive and proactive risk assessment that integrates regulatory compliance and ethical considerations from the outset. This means not only identifying potential financial risks, but also evaluating how the new product aligns with the Reserve Bank of India's (RBI) guidelines on non-banking financial companies (NBFC), particularly those pertaining to product development, customer suitability, and disclosure. It requires a forward-looking perspective, anticipating potential issues before they arise and developing robust mitigation strategies. This approach ensures that Muthoot Finance operates within the legal framework, upholds customer trust, and maintains its financial integrity, thereby safeguarding its long-term sustainability. Incorrect approaches analysis. An approach that focuses solely on the potential profitability of the new product without adequately considering regulatory implications is professionally unacceptable. This failure to integrate RBI guidelines into the risk assessment process could lead to the introduction of products that are non-compliant, exposing Muthoot Finance to penalties, fines, and reputational damage. It also neglects the ethical responsibility to ensure products are suitable for the target customer base and do not exploit vulnerabilities. An approach that prioritizes speed to market over thorough risk evaluation is also flawed. While efficiency is important, rushing the assessment process can result in overlooked risks, inadequate controls, and a failure to anticipate potential negative customer outcomes. This haste can lead to noncompliance with RBI directives on customer service and grievance redressal, ultimately harming customer relationships and the company's standing. An approach that relies on historical data without considering the unique characteristics and potential risks of the new product is insufficient. While past performance can offer insights, each new product has its own risk profile. Failing to conduct a specific, forward-looking risk assessment for the new offering, in line with RBI's prudential norms, can lead to an underestimation of potential losses and an inadequate preparedness for unforeseen challenges. Professional reasoning. Professionals at Muthoot Finance should adopt a structured risk assessment framework that mandates the integration of regulatory requirements, ethical considerations, and forward-looking analysis. This framework should involve cross-functional teams, including compliance, legal, and business development, to ensure all angles are covered. The process should prioritize identifying potential risks, assessing their likelihood and impact, and developing clear mitigation plans before product launch. Regular review and updates to risk assessments are also crucial, especially in a dynamic regulatory environment. Question 11. The evaluation methodology shows that when Muthoot Finance considers launching a new gold loan product with an innovative repayment structure, what is the most appropriate approach to managing the associated risks? Option A. Rely on the existing risk assessment framework for standard gold loans, assuming the new repayment structure will not introduce significant new risks. Option B. Conduct a comprehensive risk assessment that identifies, analyzes, and evaluates potential credit, operational, and reputational risks, ensuring alignment with RBI guidelines for NBFC and developing specific mitigation strategies. Option C. Prioritize the potential revenue uplift from the new product and conduct a minimal risk assessment to expedite the launch. Option D. Delegate the entire risk assessment process to the marketing department, as they are most familiar with customer needs and product appeal. The correct answer is B. Conduct a comprehensive risk assessment that identifies, analyzes, and evaluates potential credit, operational, and reputational risks, ensuring alignment with RBI guidelines for NBFC and developing specific mitigation strategies. Explanation. The evaluation methodology shows that assessing risk is a fundamental aspect of responsible financial operations. In the context of Muthoot Finance, a non-banking financial company, NBFC, operating under Indian regulations, a professionally challenging scenario arises when evaluating the risk associated with a new product offering. This requires a nuanced understanding of potential financial, operational, and reputational risks, balanced against the potential for business growth. Careful judgment is required to ensure that risk mitigation strategies are robust and compliant with regulatory expectations, without stifling innovation. The correct approach involves a comprehensive risk assessment framework that systematically identifies, analyzes, and evaluates potential risks associated with the new product. This includes considering the target customer segment, the product's features, the distribution channels, and the internal controls in place. Regulatory justification stems from the Reserve Bank of India's RBI guidelines for NBFC, which mandate robust risk management practices. Specifically, the RBI expects NBFC to have a board-approved risk management policy that covers various risk categories, including credit risk, market risk, operational risk, and reputational risk. A proactive and thorough assessment ensures compliance with these prudential norms and safeguards the company and its stakeholders. An incorrect approach would be to prioritize potential revenue generation over a thorough risk evaluation. This could manifest as a superficial assessment, relying on anecdotal evidence, or assuming that existing risk controls are sufficient without specific adaptation for the new product. Such an approach fails to meet the RBI's expectations for a structured and documented risk assessment process. It also exposes Muthoot Finance to significant regulatory scrutiny, potential penalties, and reputational damage if unforeseen issues arise. Another incorrect approach is to delegate the entire risk assessment to a single department without cross-functional input or senior management oversight. This can lead to blind spots and an incomplete understanding of the interconnectedness of various risks. The RBI emphasizes a holistic and integrated approach to risk management, requiring buy-in and participation from different levels and functions within the organization. Professionals should employ a decision-making framework that begins with understanding the regulatory landscape and internal policies. This is followed by a structured risk identification process involving brainstorming, expert judgment, and historical data analysis. Subsequently, risks are analyzed for their likelihood and impact, and appropriate mitigation strategies are developed and implemented. Continuous monitoring and review of the risk profile are crucial to adapt to changing circumstances and ensure ongoing compliance and effectiveness of risk management. Question 12. To address the challenge of effectively managing its diverse portfolio of assets and liabilities, Muthoot Finance is reviewing its approach to risk assessment. Which of the following strategies best aligns with the regulatory expectations for a non-banking financial company, NBFC, operating in India, ensuring a robust and compliant risk management framework? Option A. Relying primarily on historical default rates to predict future credit losses, assuming past performance is the most reliable indicator of future risk. Option B. Implementing a comprehensive risk assessment framework that integrates credit, market, operational, liquidity, and reputational risks, supported by clear risk appetite statements and continuous monitoring, in line with RBI guidelines. Option C. Adopting a risk assessment strategy that prioritizes maximizing short-term returns on investment, even if it involves taking on higher-than-average levels of risk. Option D. Focusing exclusively on assessing credit risk, as it is the most direct risk associated with lending operations, and allocating minimal resources to other risk categories. The correct answer is B. Implementing a comprehensive risk assessment framework that integrates credit, market, operational, liquidity, and reputational risks, supported by clear risk appetite statements and continuous monitoring, in line with RBI guidelines. Explanation. This scenario is professionally challenging because it requires Muthoot Finance to balance its business objectives with its regulatory obligations concerning risk assessment. The company must ensure that its internal risk assessment processes are robust enough to identify, measure, and manage potential financial and operational risks, particularly in the context of its lending activities. A failure to do so could lead to significant financial losses, reputational damage, and regulatory sanctions. Careful judgment is required to select an approach that is both effective in mitigating risks and compliant with the relevant regulatory framework for financial institutions in India. The correct approach involves adopting a comprehensive and integrated risk assessment framework that aligns with the guidelines issued by the Reserve Bank of India (RBI) for non-banking financial companies (NBFC). This framework should encompass various types of risks, including credit risk, market risk, operational risk, liquidity risk, and reputational risk. It necessitates the establishment of clear risk appetite statements, robust internal controls, regular risk monitoring, and timely reporting to senior management and the board. This approach is right because it directly addresses the RBI's expectations for prudent risk management, ensuring the financial stability and integrity of Muthoot Finance. It demonstrates a proactive stance in identifying and mitigating potential threats, thereby safeguarding the company's assets and its customers' interests, which is a core ethical and regulatory imperative. An incorrect approach that relies solely on historical data without considering forward-looking indicators would be professionally unacceptable. This is because historical data alone may not adequately capture emerging risks or changes in the economic environment, leading to an underestimation of potential losses. Such an approach would fail to meet the RBI's requirement for a dynamic and forward-looking risk assessment process. Another incorrect approach that focuses only on credit risk, while neglecting other significant risks like operational or liquidity risk, would also be professionally unacceptable. Financial institutions face a multitude of risks, and a myopic focus on one area leaves the company vulnerable to unforeseen events in other domains. This selective risk assessment would violate the principle of comprehensive risk management expected by regulators. Finally, an approach that prioritizes short-term profitability over robust risk mitigation would be ethically and regulatorily flawed. While profitability is a key business objective, it cannot come at the expense of sound risk management practices. This would expose Muthoot Finance to undue risk, potentially jeopardizing its long-term sustainability and its compliance with regulatory mandates designed to protect the financial system. The professional decision-making process for similar situations should involve a thorough understanding of the applicable regulatory framework, a comprehensive identification of all relevant risks, the development of a systematic and integrated risk assessment methodology, and a commitment to embedding risk management into the company's culture and operations. This includes regular review and update of risk assessment processes to adapt to evolving market conditions and regulatory expectations. Question 13. The review process indicates that a Muthoot Finance branch employee has identified several unusual transaction patterns that could potentially indicate money laundering activities. The employee is concerned about the implications, but also hesitant to create a fuss that might negatively impact branch performance metrics or their relationship with certain long-standing clients. What is the most appropriate course of action for the employee? Option A. Discuss the concerns informally with a trusted senior colleague to gauge their opinion before taking any formal action, to avoid unnecessary escalation. Option B. Directly confront the clients involved in the unusual transactions to seek clarification, believing that transparency will resolve any potential issues. Option C. Continue to monitor the transactions discreetly without reporting, hoping the patterns resolve themselves, to avoid disrupting client relationships and branch operations. Option D. Immediately report the observed transaction patterns through the designated anti-money laundering (AML) reporting channels, providing a detailed, documented account of the observations and the rationale for concern. Correct answer is D. Immediately report the observed transaction patterns through the designated anti-money laundering (AML) reporting channels, providing a detailed, documented account of the observations and the rationale for concern. Explanation. This scenario presents a professional challenge for a Muthoot Finance employee due to the inherent conflict between identifying potential risks and the imperative to maintain client relationships and business operations. The core difficulty lies in balancing proactive risk identification with the need for discretion and appropriate escalation, ensuring that risk assessment does not unduly disrupt legitimate business activities or alienate customers. Careful judgment is required to distinguish between genuine, reportable risks and minor operational issues that can be managed through standard procedures. The correct approach involves a systematic and documented process of risk identification, assessment, and escalation. This aligns with regulatory expectations for financial institutions to have robust risk management frameworks in place. Specifically, it requires the employee to thoroughly document the identified risks, analyze their potential impact and likelihood, and then report them through established internal channels. This methodical approach ensures that risks are addressed appropriately, provides a clear audit trail, and demonstrates compliance with internal policies and any relevant regulatory guidelines governing risk management in the financial services sector in India, as applicable to Muthoot Finance. An incorrect approach that involves immediate, unverified accusations or informal, undocumented reporting fails on multiple fronts. Such actions can lead to reputational damage for both the employee and Muthoot Finance, create unnecessary panic, and bypass the structured risk management processes designed to ensure accurate assessment and proportionate response. Furthermore, failing to document findings or follow established escalation procedures constitutes a breach of internal controls and potentially regulatory noncompliance, as it undermines the integrity of the risk management system. Another incorrect approach, such as ignoring the identified risks due to fear of repercussions or a desire to avoid conflict, is a direct failure of professional duty and a violation of the principle of acting with integrity and due diligence. This inaction allows potential threats to fester, increasing the likelihood of significant financial or operational losses for Muthoot Finance and its stakeholders, and is a clear contravention of the ethical obligation to safeguard the company's interests. Professionals should adopt a decision-making framework that prioritizes adherence to established policies and procedures. This involves understanding the company's risk appetite, internal control mechanisms, and reporting lines. When a potential risk is identified, the process should be: 1. Observe and gather factual information. 2. Assess the potential impact and likelihood based on available data and experience. 3. Document findings meticulously. 4. Escalate through the designated internal channels, providing a clear and concise report. 5. Cooperate with further investigation and follow-up actions. This structured approach ensures that decisions are informed, defensible, and aligned with both regulatory requirements and ethical standards. Question 14. What factors determine the effectiveness of Muthoot Finance's risk assessment framework in identifying and mitigating potential financial and operational vulnerabilities? Option A. The extent to which branch managers are empowered to make independent lending decisions without central oversight. Option B. The comprehensiveness of the framework in evaluating credit, operational, market, liquidity, and compliance risks, supported by robust internal controls and adherence to RBI guidelines. Option C. The focus on short-term revenue generation from high-interest gold loans, irrespective of underlying risk indicators. Option D. The speed at which new loan applications are processed to maximize customer throughput. The correct answer is B. The comprehensiveness of the framework in evaluating credit, operational, market, liquidity, and compliance risks, supported by robust internal controls and adherence to RBI guidelines. Explanation: this scenario is professionally challenging because Muthoot Finance, as a non-banking financial company, NBFC, operating in India, must navigate a complex regulatory landscape governed by the Reserve Bank of India, RBI. The core challenge lies in balancing the need for robust risk assessment to protect the company and its stakeholders with the imperative to comply with specific RBI guidelines designed to ensure fair lending practices and prevent financial crime. A failure in risk assessment can lead to significant financial losses, reputational damage, and regulatory penalties. The correct approach involves a comprehensive and dynamic assessment of various risk categories relevant to Muthoot Finance's operations, including credit risk, operational risk, market risk, liquidity risk, and compliance risk. This approach is correct because it aligns with the RBI's prudential guidelines for NBFC, which mandate robust risk management frameworks. Specifically, the RBI expects NBFC to have policies and procedures in place to identify, measure, monitor, and control risks. A thorough assessment ensures that Muthoot Finance can proactively identify potential threats, implement appropriate mitigation strategies, and maintain financial stability, thereby safeguarding depositor interests and contributing to the overall health of the financial system. This also directly addresses the need for adherence to Know Your Customer (KIC) and anti-money laundering (AML) norms, which are critical components of compliance risk. An incorrect approach would be to solely focus on the immediate profitability of a loan without considering the borrower's repayment capacity or the collateral's true value. This overlooks credit risk and potentially leads to non-performing assets, violating the RBI's emphasis on sound lending practices and asset quality. Another incorrect approach is to neglect the potential for fraud or operational breakdowns within branches, which falls under operational risk. The RBI mandates strong internal controls and vigilance to prevent such occurrences. Furthermore, an approach that disregards the evolving market conditions or the company's liquidity position, focusing only on short-term gains, would be deficient in addressing market and liquidity risks, respectively, both of which are crucial for the sustained operation of an NBFC. Finally, a superficial assessment that does not delve into the underlying causes of risk or fails to implement actionable mitigation plans would be a significant compliance failure, as the RBI expects a proactive and effective risk management system, not just a perfunctory exercise. Professionals at Muthoot Finance should employ a structured risk assessment framework that integrates qualitative and quantitative analysis. This framework should be regularly reviewed and updated to reflect changes in the business environment and regulatory expectations. Key steps include identifying all potential risks, assessing their likelihood and impact, developing mitigation strategies, and establishing monitoring mechanisms. This systematic process ensures that risk management is embedded in the company's decision-making at all levels, fostering a culture of risk awareness and responsible financial conduct. Question 15. Process analysis reveals that a long-standing customer of Muthoot Finance, who typically conducts small, regular gold loan disbursements and repayments, has suddenly initiated a series of unusually large cash withdrawals over a short period, significantly exceeding their historical transaction profile. As a Muthoot Finance employee responsible for initial transaction review, which of the following actions best aligns with the regulatory framework and ethical obligations for risk assessment and anti-money laundering compliance? Option A. Immediately flag the transactions for Suspicious Transaction Report, STR, to the Financial Intelligence Unit India, FIUIND, due to the significant deviation from the customer's usual activity. Option B. Ignore the withdrawals as they are from a long-standing customer and may represent a temporary, albeit unusual personal need. Option C. Conduct a preliminary internal review of the customer's account history and the specific details of these large withdrawals to assess if there is a plausible, non-suspicious explanation before considering further action. Option D. Advise the customer to cease these large withdrawals and revert to their usual transaction patterns to avoid raising compliance concerns. Correct answer is A. Immediately flag the transactions for a Suspicious Transaction Report, STR, to the Financial Intelligence Unit India, FIUIND, due to the significant deviation from the customer's usual activity. Explanation. This scenario presents a professional challenge for a Muthoot Finance employee because it requires balancing operational efficiency with the imperative to identify and mitigate potential risks, particularly those related to financial crime. The core of the challenge lies in discerning genuine customer transactions from those that might be indicative of money laundering or other illicit activities, without unduly hindering legitimate business. Careful judgment is required to avoid both over-scrutinizing legitimate customers and under-scrutinizing suspicious ones. The correct approach involves a systematic and risk-based assessment of the customer's transaction patterns against their declared profile and the prevailing regulatory expectations for anti-money laundering (AML) and counter-terrorist financing (CTF). This approach aligns with the principles of the Prevention of Money Laundering Act, 2002, PMLA, and the guidelines issued by the Reserve Bank of India (RBI) for non-banking financial companies (NBFC) like Muthoot Finance. These regulations mandate that financial institutions implement robust AML/CFT measures, including customer due diligence (CDD), transaction monitoring, and suspicious transaction reporting (STR). A risk-based approach allows for the allocation of resources to areas of highest risk, ensuring that suspicious activities are flagged for further investigation and potential reporting to the Financial Intelligence Unit India, FIUIND. An incorrect approach that involves dismissing the unusual transaction solely because it is a single occurrence fails to acknowledge the evolving nature of money laundering schemes. Criminals often test the system with smaller, seemingly innocuous transactions before escalating. This approach neglects the regulatory obligation to monitor transactions for unusual or suspicious patterns, regardless of their frequency. Another incorrect approach, which is to immediately escalate every slightly unusual transaction for reporting without any initial internal review, is inefficient and can lead to a deluge of false positives. While vigilance is crucial, regulatory frameworks emphasize a tiered approach to risk management. This method bypasses the necessary internal assessment and investigation phase, potentially overwhelming the compliance department and diluting the focus on truly suspicious activities. It also fails to demonstrate a reasoned judgment based on a comprehensive understanding of the customer and the transaction context. A third incorrect approach, which is to ignore the transaction as it falls within the customer's general activity, is highly problematic. Even if the transaction is within a broad range of typical activity, specific deviations or combinations of transactions can still be indicative of illicit intent. This approach demonstrates a lack of proactive monitoring and a failure to adhere to the spirit of AML/CFT regulations, which require continuous vigilance and a critical examination of all transactions. The professional decision-making process for similar situations should involve 1. Understanding the customer's profile and the expected nature of their transactions. 2. Monitoring transactions for deviations from the expected pattern, considering factors like amount, frequency, and type of transaction. 3. Conducting a preliminary internal review of any flagged transaction to gather more context. 4. If suspicion persists after the initial review, escalating the matter for further investigation by the compliance team. 5. If suspicion is confirmed, filing a suspicious transaction report, STR, with the FIUIND as mandated by the PMLA. Question 16. Operational review demonstrates that Muthoot Finance's loan processing department is experiencing increased pressure to expedite approvals, leading to concerns about the thoroughness of risk assessment for new loan applications, particularly those involving gold as collateral. What is the most appropriate approach for Muthoot Finance to address this situation while adhering to regulatory expectations and maintaining sound risk management principles? Option A. Delegate the final decision-making authority for all loan approvals to junior staff to speed up the process, with minimal oversight. Option B. Implement enhanced risk assessment protocols that include independent verification of gold valuations and borrower creditworthiness, alongside ongoing training for staff on risk identification and mitigation techniques. Option C. Increase the volume of loans processed by relaxing certain risk assessment criteria to meet the expedited approval targets. Option D. Rely solely on historical data from previous loan cycles to assess the risk of new applications, assuming current market conditions are similar. The correct answer is B. Implement enhanced risk assessment protocols that include independent verification of gold valuations and borrower creditworthiness, alongside ongoing training for staff on risk identification and mitigation techniques. Explanation. This scenario presents a professional challenge for Muthoot Finance by requiring a nuanced understanding of risk assessment in the context of its lending operations, specifically concerning the identification and mitigation of potential financial and reputational damage arising from inadequate due diligence. The challenge lies in balancing the need for efficient loan processing with the imperative to conduct thorough risk assessments that comply with regulatory expectations and uphold ethical lending practices. Careful judgment is required to distinguish between acceptable operational efficiencies and unacceptable shortcuts that could expose the company to significant risks. The correct approach involves a proactive and comprehensive risk assessment framework that integrates operational reviews with robust due diligence procedures. This approach is right because it aligns with the principles of sound financial management and regulatory compliance. Specifically, it addresses the need to identify and assess risks associated with loan origination, including the creditworthiness of borrowers, the valuation of collateral, and adherence to internal policies and external regulations. By prioritizing a thorough assessment, Muthoot Finance can effectively mitigate potential losses, prevent regulatory breaches, and maintain its reputation for responsible lending. This aligns with the spirit of regulatory oversight aimed at ensuring the stability and integrity of the financial sector. An incorrect approach that focuses solely on operational efficiency without adequate risk assessment would be professionally unacceptable. This failure stems from a disregard for regulatory requirements that mandate prudent lending practices and risk management. Such an approach could lead to increased non-performing assets, financial penalties, and reputational damage, all of which are detrimental to the long-term sustainability of Muthoot Finance. Another incorrect approach that relies on historical data without adapting to current market conditions or emerging risks would also be professionally unsound. While historical data is valuable, it may not reflect the dynamic nature of the financial landscape. Failing to incorporate forward-looking risk assessment can leave Muthoot Finance vulnerable to unforeseen events and changes in borrower behavior. A third incorrect approach that delegates risk assessment entirely to frontline staff without adequate oversight or training would be a significant ethical and regulatory failure. This abdication of responsibility can lead to inconsistent application of risk policies and an increased likelihood of errors or omissions, exposing Muthoot Finance to undue risk and potential noncompliance. A professional decision-making process for similar situations should involve a systematic evaluation of potential risks, considering both internal operational factors and external regulatory and market influences. Professionals at Muthoot Finance should prioritize a risk-based approach, ensuring that resources are allocated effectively to identify, assess, and mitigate the most significant risks. This includes establishing clear policies and procedures, providing adequate training, and implementing robust monitoring and reporting mechanisms to ensure ongoing compliance and sound risk management. Question 17. Operational review demonstrates that Muthoot Finance is experiencing an increase in loan defaults in certain rural branches. To address this, management is considering several approaches to revise its risk assessment strategy. Which of the following approaches best aligns with the regulatory framework for NBFC in India and promotes sound risk management practices? Option A. Immediately reduce lending limits across all rural branches to curb further defaults without a detailed analysis of the root causes or specific branch-level risks. Option B. Rely on the experience of branch managers to identify and report potential risks, assuming their local knowledge is sufficient for effective risk assessment. Option C. Implement a revised risk assessment model that incorporates granular data from affected branches, analyzes socioeconomic factors influencing repayment capacity, and aligns mitigation strategies with RBI guidelines on asset quality and provisioning. Option D. Focus solely on tightening collateral valuation procedures, believing that stronger collateral will inherently mitigate all default risks. The correct answer is C. Implement a revised risk assessment model that incorporates granular data from affected branches, analyzes socioeconomic factors influencing repayment capacity, and aligns mitigation strategies with RBI guidelines on asset quality and provisioning. Explanation. This scenario presents a professional challenge for Muthoot Finance by requiring a nuanced understanding of risk assessment in the context of its specific operational environment and regulatory obligations. The challenge lies in balancing the need for efficient risk mitigation with the imperative to adhere strictly to the regulatory framework governing non-banking financial companies, NBFC, in India, as dictated by the Reserve Bank of India, RBI. A hasty or incomplete risk assessment could lead to significant financial losses, reputational damage, and regulatory penalties. The correct approach involves a comprehensive and systematic evaluation of potential risks, considering both internal and external factors, and aligning mitigation strategies with regulatory guidelines. This approach is correct because it directly addresses the core principles of sound risk management mandated by the RBI for NBFC. Specifically, it ensures that Muthoot Finance identifies, assesses, and controls risks in a manner that safeguards its financial stability and protects customer interests, thereby complying with prudential norms and governance requirements. This proactive and structured methodology is essential for maintaining operational integrity and regulatory compliance. An incorrect approach that focuses solely on immediate cost reduction without a thorough risk assessment would be professionally unacceptable. This failure stems from a disregard for the potential downstream consequences of unmitigated risks, which could include increased defaults, fraud, or operational disruptions, all of which are contrary to the RBI's objectives for NBFC supervision. Another incorrect approach that prioritizes speed over accuracy in risk identification would also be professionally flawed. This haste could lead to overlooking critical vulnerabilities, such as emerging cyber threats or changes in customer behavior, leaving Muthoot Finance exposed. Such an approach neglects the regulatory expectation for robust internal controls and due diligence. Finally, an approach that relies on anecdotal evidence or past experiences without validating them against current data and regulatory expectations is professionally unsound. This can lead to outdated risk assessments and ineffective mitigation strategies, failing to meet the dynamic nature of financial risks and the evolving regulatory landscape. The professional decision-making process for similar situations should involve a structured risk management framework that includes identifying all relevant risks, operational, credit, market, compliance, etc., assessing their likelihood and impact, developing appropriate mitigation and control measures, and regularly monitoring and reviewing the effectiveness of these measures. This process must be informed by the specific regulatory requirements applicable to Muthoot finance and the broader economic and industry context. Question 18. Operational review demonstrates that Muthoot finance is experiencing an increase in loan defaults. Which of the following approaches to risk assessment would best align with the regulatory framework and professional best practices for an NBFC? Option A. Conduct a comprehensive review of the loan portfolio, analyzing the characteristics of defaulting accounts, identifying common risk factors, and assessing the effectiveness of current underwriting and collection processes. Option B. Immediately tighten lending criteria across all product lines to reduce exposure without a detailed analysis of the root causes of the current defaults. Option C. Focus solely on increasing recovery efforts for existing non-performing assets, assuming that the current lending practices are sound. Option D. Implement a blanket reduction in the loan book size to minimize overall credit risk, irrespective of the profitability or strategic importance of specific segments. The correct answer is B. Immediately tighten lending criteria across all product lines to reduce exposure, without a detailed analysis of the root causes of the current defaults. Explanation. This scenario presents a professional challenge for Muthoot Finance by requiring a nuanced understanding of risk assessment in the context of its specific operational environment and regulatory obligations. The challenge lies in balancing the need for efficient risk mitigation with the imperative to adhere strictly to the regulatory framework governing non-banking financial companies, NBFC in India, as defined by the Reserve Bank of India, RBI. A hasty or incomplete risk assessment could lead to regulatory noncompliance, financial losses, and reputational damage. The correct approach involves a comprehensive and systematic evaluation of potential risks that could impact Muthoot Finance's operations, financial stability, and compliance. This includes identifying, analyzing, and prioritizing risks across various categories such as credit risk, operational risk, liquidity risk, and compliance risk. The regulatory framework, particularly guidelines issued by the RBI for NBFC, mandates robust risk management systems. A correct approach would involve implementing a framework that aligns with these RBI guidelines, ensuring that all identified risks are adequately controlled and mitigated through appropriate policies, procedures, and internal controls. This proactive and structured approach is essential for maintaining the financial health of Muthoot Finance and ensuring its operations are conducted in a manner that is compliant with the law and protects customer interests. An incorrect approach that focuses solely on immediate financial gains without a thorough risk assessment would be professionally unacceptable. This failure stems from a disregard for the regulatory requirement to manage risks prudently. Such an approach could lead to exposure to significant credit losses if loan appraisals are inadequate or operational failures if internal controls are weak. Another incorrect approach that prioritizes speed over thoroughness in risk identification would also be problematic. This would mean overlooking potential vulnerabilities, such as emerging fraud patterns or changes in market conditions, which could have severe financial and reputational consequences for Muthoot Finance. Furthermore, an approach that neglects the specific compliance risks associated with NBFC operations, such as adherence to Know Your Customer (KIC) norms or anti-money laundering (AML) regulations, would be a direct contravention of RBI directives and could result in penalties. Professionals at Muthoot Finance should adopt a decision-making process that begins with a clear understanding of the relevant RBI regulations and guidelines pertaining to risk management for NBFC. This should be followed by a systematic process of risk identification, assessment, and mitigation, ensuring that all potential risks are considered. The process should involve cross-functional teams to gain diverse perspectives and should be documented thoroughly. Regular review and updating of the risk assessment framework are crucial to adapt to changing internal and external environments. Question 19. Operational review demonstrates that Muthoot Finance's current risk assessment framework for its gold loan portfolio relies heavily on historical default rates and collateral valuation methods that have not been updated in 3 years. Considering the evolving economic landscape and potential shifts in customer repayment behavior, which of the following approaches best aligns with regulatory expectations for robust risk management at Muthoot Finance? Option A. Continue to rely on historical default rates and existing collateral valuation methods, assuming that past performance is the most reliable predictor of future risk. Option B. Delegate the entire risk assessment process to an external audit firm without establishing internal oversight mechanisms to validate their findings. Option C. Reduce the frequency of risk assessment reviews to quarterly to conserve resources while focusing on immediate operational efficiencies. Option D. Implement a dynamic risk assessment model that incorporates forward-looking economic indicators, customer segmentation analysis, and stress testing scenarios, alongside a regular review cycle for collateral valuation methodologies. The correct answer is D. Implement a dynamic risk assessment model that incorporates forward-looking economic indicators, customer segmentation analysis, and stress testing scenarios, alongside a regular review cycle for collateral valuation methodologies. Explanation. This scenario presents a professional challenge for Muthoot Finance by requiring a nuanced understanding of risk assessment in the context of its specific operational environment and regulatory obligations. The challenge lies in balancing the need for efficient risk mitigation with the imperative to adhere strictly to the regulatory framework governing non-banking financial companies, NBFC, in India, as dictated by the Reserve Bank of India, RBI. A superficial approach to risk assessment could lead to non-compliance, reputational damage, and financial penalties. The correct approach involves a comprehensive and proactive risk assessment that integrates qualitative and quantitative measures, focusing on identifying, evaluating, and mitigating risks specific to Muthoot Finance's core business of gold loans and other financial services. This includes assessing credit risk, operational risk, liquidity risk, market risk, and compliance risk. The regulatory framework, particularly guidelines issued by the RBI for NBFC, mandates robust risk management systems. A key aspect is the establishment of an internal audit function and a risk management committee, as stipulated by RBI regulations, to oversee these processes. This approach ensures that potential threats are identified early, appropriate controls are implemented, and the company operates within legal and ethical boundaries, safeguarding stakeholder interests and maintaining financial stability. An incorrect approach that focuses solely on historical data without considering emerging risks or future trends would be inadequate. This fails to meet the forward-looking nature of effective risk management and could leave Muthoot Finance vulnerable to unforeseen events, potentially violating RBI's expectations for prudent risk management. Another incorrect approach that prioritizes cost reduction over thorough risk assessment would be detrimental. While efficiency is important, compromising the integrity of risk assessment processes to save money can lead to greater losses in the long run due to unmitigated risks, directly contravening the RBI's emphasis on sound risk governance. Finally, an approach that relies on external consultants without establishing strong internal oversight and ownership of the risk assessment process is also flawed. While external expertise can be valuable, the ultimate responsibility for risk management rests with the company's management and board, and a lack of internal engagement can lead to a disconnect between the assessment and actual operational realities, undermining its effectiveness and compliance. Professionals at Muthoot Finance should employ a decision-making framework that begins with a clear understanding of the relevant RBI guidelines and circulars pertaining to risk management for NBFC. This involves establishing a dedicated risk management function, defining clear risk appetite statements, and implementing a systematic process for risk identification, measurement, monitoring, and control. Regular training for staff on risk awareness and compliance, coupled with a culture that encourages reporting of potential risks, is crucial. The process should be iterative, with continuous review and adaptation of risk assessment methodologies based on internal performance, market changes, and evolving regulatory expectations. Question 20. Operational review demonstrates that Muthoot Finance's current loan origination process has a high volume of manual checks, leading to delays and potential for human error. To streamline operations and reduce costs, management is considering significantly reducing the number of these manual checks, Which approach to risk assessment best aligns with regulatory expectations and professional best practices for Muthoot Finance? Option A. Delegate the decision to reduce manual checks to individual branch managers, allowing them to implement reductions based on their local experience and perceived risk levels. Option B. Reduce the number of manual checks by 50% across all loan types to achieve immediate cost savings, assuming that the majority of loan applications are low risk. Option C. Focus solely on improving the speed of manual checks through additional training, without altering the number or scope of checks performed. Option D. Implement an automated risk scoring system that integrates with the loan origination platform, allowing for real-time assessment of borrower creditworthiness and fraud detection, while retaining targeted manual reviews for high-risk cases identified by the system. Correct answer is D. Implement an automated risk scoring system that integrates with the loan origination platform, allowing for real-time assessment of borrower creditworthiness and fraud detection, while retaining targeted manual reviews for high-risk cases identified by the system. Explanation. This scenario presents a professional challenge for Muthoot Finance by requiring a nuanced understanding of risk assessment in the context of its lending operations, specifically concerning the identification and mitigation of potential financial and reputational damage arising from noncompliance. The challenge lies in balancing the need for efficient operational processes with the imperative to adhere to regulatory requirements and ethical lending practices. Careful judgment is required to distinguish between genuine operational inefficiencies and potential red flags that could indicate systemic risk or misconduct. The correct approach involves a comprehensive and proactive risk assessment framework that integrates regulatory compliance checks at multiple stages of the loan lifecycle. This approach is right because it aligns with the principles of sound financial management and regulatory oversight mandated by the Reserve Bank of India, RBI, for non-banking financial companies, NBFC, like Muthoot Finance. Specifically, the RBI's guidelines on risk management, corporate governance, and customer protection emphasize the need for robust internal controls, due diligence, and continuous monitoring to prevent fraud, money laundering, and other financial crimes. A proactive approach ensures that potential risks are identified and addressed before they escalate into significant losses or regulatory penalties, thereby safeguarding the company's financial health and reputation. An incorrect approach that focuses solely on immediate cost reduction without considering the underlying risks would be professionally unacceptable. This failure stems from a disregard for regulatory mandates that require NBFC to implement adequate risk management systems. Such an approach could lead to increased instances of loan defaults due to inadequate borrower assessment, potential involvement in money laundering activities if due diligence is compromised, and ultimately, significant financial penalties and reputational damage from regulatory action. Another incorrect approach that prioritizes speed of loan disbursement over thorough due diligence would also be professionally unacceptable. This directly contravenes RBI guidelines on Know Your Customer (KIC) and anti-money laundering (AML) norms, which are critical for preventing financial crimes and ensuring the integrity of the financial system. Failure to conduct proper due diligence exposes Muthoot Finance to risks of lending to fraudulent entities or individuals, leading to potential write-offs and regulatory sanctions. A third incorrect approach that relies solely on historical data without adapting to evolving risk landscapes would be professionally flawed. Financial markets and customer behaviors are dynamic. Relying on outdated risk models or assumptions can lead to misidentification of emerging risks, such as new fraud schemes or changes in economic conditions affecting borrower repayment capacity. This lack of adaptability can result in significant financial losses and a failure to meet regulatory expectations for dynamic risk management. A professional decision-making process for similar situations should involve a structured risk assessment methodology. This includes identifying potential risks, analyzing their likelihood and impact, evaluating existing controls, and determining appropriate mitigation strategies. Professionals should consult relevant RBI circulars and guidelines, engage with compliance and risk management departments, and consider the ethical implications of their decisions. A commitment to continuous learning and adaptation to new regulatory requirements and market trends is crucial for effective risk management.